Assalamualaikum and hi. We as a Group 3 will be presenting regarding on employee benefits retirement plans. For the first question, explain the following terms from any supporting articles. A plan asset. According to Smart Capital Mind website, a plan asset is a financial asset maintained in a retirement plans that generates revenue to help support the plan. Plan assets are often varied in nature with the purpose of diversifying a retirement plan and decreasing exposure to losses, especially when members are nearing retirement and rely on income from the plan. Then Obaidullah Jan, as a writer, explain.com, said that the assets or investment maintained by a long-term employee benefit fund for the purpose of providing benefits to employees are referred as a plan assets. Long-term investment and qualifying insurance plans are example of this. Only assets owned by the legal organization explicitly established to manage the pension fund qualify as plan assets. Examples of plan assets can include stocks, bonds, and mutual fund investment. Assets are selected on the basis of returning steady and reliable investments. Second, pension assumption. In most cases, pension assumptions can be defined as the projected series of benefit payment is then discounted using specified rate of interest to determine a present value, to reflect the fact that funds help now to meet future liabilities can be invested internally or externally and earn additional income before they are required to make benefit payments. Therefore, pension assumptions can be classified into three types. There are several that appear to be the sole domain of the actuary, such as mortality and disability rates. There are those that frequently rely on the plan sponsor's specialist expertise, such as expected terminate rate and the age of which participants are expected to retire. The third category includes the assumption on which everyone appears to be an expert. The rate for discounting obligations, sometimes known as the interest rate or the expected rate of return on investment. Thirdly, defined benefits DB pension plans. According to Forbes Advisor, defined benefit plan is a retirement plan sponsored by a qualifying employer. This ensures they are eligible for certain tax benefit provided by the legislation, such as tax deferred, investment growth or tax deduction for contributions. Defined benefit plans are typically wholly supported by employer contributions. However, employees may be compelled to make some payments in certain situations. The DB plan is concerned with the flow of benefits that an individual will get upon retirement. A typical DB plan calculates an employee's benefit based on both years of service and pay history. Defined benefit pension, the classic plans that give guarantee benefit based on years of service and final salary from retirement until death, were formerly the most prevalent option for workers to save for retirement. Then, according to Equitable Financial Life Insurance Company website, they demonstrate defined benefit plans are employer-sponsored retirement plans that meet certain criteria. They, like other qualifying plans, provide tax benefit to both employers and participants. Contribution to the plan, for example, can normally be deducted by employer, and in most cases, employees do not have to pay tax on those contributions until they start getting distribution from the plan, usually during retirement.
Question number 2. referring to any two different articles, explain the factor driven the conflicting interests of workers and shareholders from pension assumption manipulation. For the first article, I have referred to the article by Daniel Bergstrasse, Meher Edesai, Joshua Rowe, 2004, which titled Earning Manipulation and Managerial Investment Decision, Dividend from Sponsored Pension Plan. In short, it is a research paper about earning manipulation done by the management using pension assumption manipulation to alter investment decision. Even though the paper did not precisely describe the conflict of interest between workers and shareholders from pension assumption manipulation, like in the research paper by J. Adam Cobb, but this paper did highlight a certain point which could be a contradictory interest between shareholder and employee. The paper described that the size of defined benefit pension plan and managers' wide latitude in characterizing them to capital market make pension accounting a fertile area for earning manipulation. From this paper, we will look into the first factor which driven the conflict of interest, which is shareholder interest. Shareholder interest always is to maximize profit. The managerial use pension accounting to boost their firm reported profit. By simply increasing the assumed long-term rate of return on pension asset, they could manipulate and increase the income of the firm. This will satisfy the interests of the shareholder. But how could this be contradictory with the interests of the employee? To answer this question, we'll refer to the second article from hg.org, a legal resource website. The title of the article is Employer Misuse of Pension Fund. To summarize, this article basically explains pension fund manipulation by the employer from a legal viewpoint. Manipulation of pension fund might benefit shareholder, but the employee will bear the risk from such manipulation. Typically, an employer may make use of deceit or misrepresentation in pension fund or account that may lead to false claim and detail about the pension itself. This affects the individual employee when he or she reach retirement age, and if without uncovered, it may lead to further complication. What we can say is that the employee do not want their pension fund to be manipulated by management to satisfy the need of shareholder. They did not want to risk their pension fund for only short-term benefit of the firm. In conclusion, the firm should make a proper consideration on how to address the conflicting interests of workers and shareholders from pension assumption manipulation. Even though the earning management by manipulating the pension assumption could be sometimes helpful for the company, but the management should also consider the harmful side of the earning management.
Question 3. Based on conflicting interests above, apply any two theories. First, contract theory. Based on Investopedia, contract theory look at how individuals and businesses build and develop legal agreements. Contract theory looks at how multiple parties trying to come to an agreement work with conflicting interests and different levels of information. Contract theory covers the implied trust between the different parties and investigate the formation of contracts in the presence of asymmetric information which occur when one party to an economic transaction possesses greater material knowledge than the other party. One of the most prominent applications of contract theory is how to design employee benefit optimally. Contract theory examines a decision maker's behavior under specific structures. Under these structures, contract theory aims to input an algorithm that will optimize the individual decision. Three models have been developed to define ways for the parties to take appropriate action under certain circumstances stated in the contract. Moral hazard, adverse selection, and signaling. A moral hazard model portrays a principal who has an incentive to engage in risky behaviors because the associated costs are absorbed by the other contracting party. For moral hazard to be present, there must be information asymmetry and contract that provide an opportunity for a party to alter their behavior. To counter moral hazards, some companies create employee performance contract, which depends on observable and confirmable action to serve as incentive for parties to act according to the principal interest. Then, an adverse selection model portrays a principal who has more or better information than the other contracting party and therefore distorts the market process. Adverse selection is common in the insurance industry. Some insurers provide coverage for policyholders who withhold valuable information during the application process to obtain protection. Without asymmetric information, this policyholder will likely not be insured or will be insured at unfavorable rates. Third, the signaling model is when one party adequately convey knowledge and characteristic about itself to the principal. In economics, the signaling includes the transfer of information from one party to another. The purpose of this transfer is to achieve mutual satisfaction for a specific contract or agreement. The second theory is pecking order theory. According to Corporate Finance Institute, the theory stated that manager follows a hierarchy when considering sources of financing. The pecking order theory states that managers display the following preference of sources to fund investment opportunities. First, through the company's retained earning, followed by debt, and choosing equity financing as a last resort. Arises from the concept of asymmetric information. Asymmetric information, also known as information failure, occurs when one party possesses more or better information than another party, which causes an imbalance in transaction power. Company managers typically possess more information regarding the company's performance, prospect, risks, and future outlooks than external users such as creditors or debt holders and investors, the shareholders. Therefore, to compensate for information asymmetry, external users demand a high return to counter the risks that they are taking. In essence, due to information asymmetry, external sources of finances demand a higher rate of return to compensate for higher risks. Retained earnings financing or internal financing comes directly from the company and minimizes information asymmetry. External financing, which is debt or equity, a higher return is demanded because creditors and investors possess less information regarding the company. Internal financing is the cheapest and most convenient sources of financing. External financing, the cost of debt is lower compared to the cost of equity. Thinking of the pecking order theory, it is useful to consider the seniority of claims to assets. Debt holders require a lower return as opposed to stockholders because they are entitled to a higher claim to assets, which is in the event of bankruptcy. Therefore, when considering source of financing, the cheapest is through retained earnings, second through debt, and third through equity.